Welcome back to the Wall Street Podcast. Today we're digging into the latest Wall Street Journal report, WL7.28.PDF, which came out this Monday, July 28th, 2025. It gives a pretty critical look at some key shifts happening right now. Market behavior, corporate moves, policy changes. Quick market snapshot from last week. The Dow was up 1.26%, NASDAQ gained 1.0%, but the CIX 600 slipped 0.5%, and the 10-year Treasury yield 4.385%. Beyond those numbers, though, what really jumped out at you from this report?
Well, right away, the personal finance angle is quite striking. The report flags a record 4.8% of 401k participants taking hardship distributions last year.
4.8%.
Yeah, and compare that to the pre-pandemic average, which was closer to 2%. It's more than double.
That's significant.
It really is. It suggests, a real squeeze on household finances. People are tapping into long-term savings for immediate needs. That's a big shift.
A profound shift, definitely. But then, almost paradoxically, the report also talks about market froth, speculative stocks, crypto prices surging, and maybe most notably, this equity risk premium, the extra yield stocks offer over bonds, it's near zero. The report calls it unhealthy. What does that actually mean for investors?
It means the traditional reward for taking on stock market risk has basically vanished, at least compared to safer bonds right now. It forces a rethink.
So what are investors doing? Are they just moving to bonds?
Some might be, but we're also seeing a clear rotation. Investors seem wary of the sky-high valuations in tech, the big names. They're hunting for bargains, looking for less expensive alternatives.
A bargain hunt, okay. Almost like echoes of the dot-com era.
There are some parallels being drawn, certainly, and you mentioned crypto, Bitcoin, and others have surged. That seems partly driven by, friendlier policies perhaps, and even some companies adding it to their balance sheets. It's another sign investors are reaching for returns wherever they can find them.
Okay, so a tricky market environment. Let's pivot to what companies themselves are doing. We see big names, Wells Fargo, BofA, Microsoft, talking about staff cuts.
Right, and they're framing it as efficiency gains, often linked to AI.
Efficiency gains. Even as the overall labor market seems to be cooling. Private sector job growth is reportedly at an 8-month low.
Exactly, and that's the tension. Is AI genuinely creating that much efficiency already? Or is it perhaps a convenient justification for reducing headcount or slowing hiring in a potentially weaker economic climate?
So it could mean higher revenue per employee, but fewer employees overall.
That seems to be the playbook for some. And the potential knock-on effect for the broader economy is significant less job security, maybe weaker consumer spending down the line.
And this isn't just a U.S. thing, right? Trayton cutting production.
Yes, the report mentions Trayton reducing production due to softer demand and uncertainty around tariffs, specifically from North America. So global headwinds are definitely part of the picture.
Okay, let's talk policy. Big news on the trade front. The Trump administration announced a deal with the EU.
Correct. Aimed at avoiding a wider trade war. It sets a baseline tariff, 15%, on many European goods, cars, semiconductors included.
And a big energy purchase commitment from the EU, too, wasn't there?
Yes, $750 billion in U.S. energy products. So it stabilizes trade, though some analysis suggests it might trim the EU's GDP slightly, maybe 0.3%.
And domestically, regulation seems to be shifting, too, particularly the CFPB.
That's right, the Consumer Financial Protection Bureau. The administration appears to be fast-tracking deregulation there. We're seeing cases dropped, like that Navy federal $80 million refund case, and less emphasis on enforcement overall.
Backdoor deregulation is how some describe it.
That's the term being used. The concern raised is whether this might, roll back some consumer protections put in place after the 2008 crisis.
And this aligns with other pushes, like in energy.
It seems to. There's a clear push towards fossil fuels, and private equity is stepping in, investing billions in new natural gas plants, just as renewable energy faces some challenges.
One last area the report highlights: housing. A shift in who's buying single-family homes.
Yes, investors now account for 30% of purchases in 2025. Small investors particularly, that's the highest share ever recorded.
30%. Does that suggest a different kind of froth building, maybe making it harder for typical homebuyers?
It certainly adds another complex layer, more competition for sure. It raises questions about affordability and market dynamics going forward.
So bringing it all together, you have policy shifts, new tech, like AI impacting jobs, strained consumer finances alongside market froth, and shifts in housing. It's a lot to balance.
It really is. As you think about your own financial planning or business strategy, you have to consider how these forces, policy, technology, market signals interact, how they might shape stability and opportunity in the next few quarters.
Definitely a lot to mull over. Thanks for breaking that down.
My pleasure.